Construction activity picks up in the first few months of the year. Therefore, it should be a busy time for APL Apollo Tubes, the leading steel structural building material player in the country. So how would the company describe the start to this year? Let's ask the Chief Strategy Officer, Mr. Anubhav Gupta. He's joining us right now. Anubhav, thanks very much for taking out the time. This environment is very challenging. So probably to draw a like-to-like comparison from what generally a good year looks like versus what the start of this year would look like would not be correct. So let me ask you, the start of this year, how has it been for you in conjunction to the environment that we are in?
Sure. Good morning, everyone, and thanks for having me on this show. So if you look at our performance so far in the first 9 months until December 2019, we have done around 25% volume growth at the group level with margin expansion as well. So things have been going quite good for us because we believe that the structural steel market in India is at a very nascent stage, which is only 4% of the total steel consumption versus global average of 10 to 12%. Because the architects, engineers, and the developers are still looking at the conventional construction methodologies, whereas outside India, the developers have started using more steel other than rebar, which is more time-saving and also cost-effective. So we have started seeing this trend emerging in India, and that's why it has helped us grow our sales volume at high double-digit for the first 9 months until December 19.
Okay, you know, even in such times, overall volume growth for you has been trending higher. Aside from the fact that it was also aided by Apollo Tri-Coat, 71% quarter-on-quarter rise that you saw, is this something that is an aberration or something that you feel is you can clock in on a consistent basis?
Right. So Apollo Tri-Coat, which is our 51% subsidiary, it started its business last year. It has around half a dozen products which were being introduced in India for the very first time. They are being manufactured in India only by Apollo Tri-Coat in our factories. So the reception for those products have been quite good. It has also surprised us how the market has absorbed these new launches. And obviously, because there is no competition for those categories, we are having a better margin. And on the back of a strong distribution network from APL Apollo, we have been able to ramp that company pretty well in 6 to 9 months.
Okay, so improvement in demand, overall market share gains, value-added product share growing, and acquisition of Shankara Building Products plant, all of these factors, as well as restocking of inventory by channel partners, all of these put together really helped you out. Each of these parameters, would they be the reason for which your numbers could continue to look good going forward as well?
Right. So if you look at last 2 years for our group, we have increased our capacity from 1.3 million ton to 2.5 million ton. This includes the organic capex plus 2 acquisitions. One is Shankara plant and the second is Apollo Tri-Coat. In last 2 years, we have increased our sales volume by 20% year on year. So we have grown our business by 50%. We have doubled our capacity, and our debt is unchanged. Right. In fact, we have improved our net working capital cycle days. So as APL Apollo is increasing its dominance in the structural steel market, the support which we are getting from our channel partners is also very encouraging. We are able to dictate the payment terms, which is visible in our cash flow improvement. So on this 2.5 million ton capacity, the current run rate as per the first 9 months is around 1.6 million tons. So we have next 2 years sufficient capacity to kind of grow our volume in high double digits, which we believe is possible. Obviously, whatever happening at the macro level could play a bit spoil sport, but I think for double-digit growth, we shouldn't see much of a challenge because of our vast network, new product launches, and of course our main focus on the value-added products and identifying new applications where steel tubes, the structural steel tube, can replace the conventional construction methodologies, which is usage of wood, concrete, and UPVC.
Okay. Let's talk about market share gains. Do you feel that you could get in more from the unorganized sector, as well as the kind of products that you're looking to introduce now, and how they will aid the overall top line?
So how we identify the value-added products is that which new applications we can introduce, which can replace wood with our steel tubes. For one good example, last year which we launched were the chalk hut product, the wooden door frame, right? So our chalk hut tube is replacing the wooden door frames in a significant way in North and South India. Because with wood you have a termite problem, you have a maintenance problem, and it is expensive as well. Whereas if you use Apollo chalk hut, it is 15 to 20% cheaper than wood. There is no termite problem, and after 10 years also it will have a recyclable value. So this was one new launch which we had last year. Then the other launch was high diameter, high thickness steel tubes, which are like above 300 by 300 diameter. Those tubes are replacing the conventional RCC and concrete columns in the buildings for the skyscrapers. Again, the idea was that how we can replace our steel tubes with the conventional construction methodologies. So our team, it keeps on identifying new areas where we can replace the existing construction products with our steel tubes. So this endeavor is ongoing. We have a team of 50 members who keep on identifying such new applications.
Anubhav, would it be safe to say that double-digit volume growth might be the new normal for you for the next couple of years, if not longer? And would there be superior EBITDA growth as a result of the volumes moving up and you moving into value-added products?
So see, if you look at our group history, in last 10 years, our volume growth has been consistent above 20%. If you look at 5 years, it is same 20%. If you look at last 3 years, last 3 quarters, we have grown above 20%. So yes, at this scale, I mean, we would want to continue to grow at 20%, but then we may ask for a bit improvement in the macro factors, which right now we are not seeing. So conservatively, we are saying that we should be able to grow in double-digit margin. And yes, if there is some natural pull from the industry side, why can't we grow faster? And yes, the focus is on the margin expansion, is the launch of more value-added products, inclusion in our portfolio, so that we move towards better margin. The EBITDA growth needs to be superior than the volume growth. That's our current endeavor.
So in light of that, what kind of EBITDA per ton is your target range? I mean, you'd earlier on guided for 3,400 to 3,500 rupees. Is that something that you stick by?
So for the, if you look at the group EBITDA for the first 9 months, it is around 3,300 per ton, which we believe there is significant scope of improvement as we are increasing our value-added portfolio. So you can imagine that if we are growing our volume at double-digit, the EBITDA growth will be superior than that. So one can calculate what kind of numbers we can achieve at the EBITDA per ton level.
Okay, just to put it into perspective, 3,400, 3,500 is achievable, right?
That's right.
Okay. Just the other thing, what's your expectation with regards to steel prices? I mean, if you're talking about them having bottomed out, no more inventory losses expected?
No, so see, if you look at our business model, we carry a certain inventory of raw material in our system because we have 10 plants running. We have to maintain more than 2,000 SKUs for our sales partners. So we must have some HR qual inventory always at our plants, and if the volume is going good, then there is no excess inventory in the system, which leads to any inventory loss or gains if there is a fluctuation in steel prices. So as long as we are achieving the sales volume growth, we shouldn't see much of excess inventory in our system. So it will prevent us from any inventory gains or losses. So we are working towards making our system more shock proof, that even if there is a high volatility in steel prices, we shouldn't be impacted, because we are in process of, our business is to convert raw steel commodity into a brand, right? So when we sell our product as brand, you de-risk, you decommoditize your portfolio, and that's how you make your company shock proof. So that's what we are trying to achieve right now.
Just want your sense on which segment or which product is it that you're going to likely see the biggest volume churn coming from? Is it going to be Apollo Build or Apollo Structurals, Apollo Z, that's the GP pipes, or Apollo Tricoat, which we just spoke about?
Right. So right now there are three product categories which are bringing us a higher volume market share. Number one is Apollo Structural, which is we have three brands here: Fabritech, Build, and DFT. The main application for these brands is the building material construction, which is replacing the concrete and TMT bars. This is one segment which we are pretty much excited about. Then Apollo Z, which is our structural portfolio for the coastal markets. It's the galvanized portfolio. In coastal regions, we have very high market share with, like, in some of the key markets like Kerala and Maharashtra Konkan, we have market share above 55%. So this is one category. And then of course Apollo Tricoat, which I mentioned earlier, that this was launched last year, and we have seen very strong ramp up within 2 to 3 quarters of product launches. So yes, it has also helped us gain significant market share.
Anubhav, I believe during the earnings interactions, or maybe on the conference call, you guys crystal gazed that if indeed things go as per plan, if India doubles steel consumption, structural tubing as a percentage of market grows to 10% of global average, there is a 4x opportunity that can be tapped into. What would this do to the company? And say 10 years is too long, but over the next 5 years, what does, if all of this materializes, what's the extent of growth in, say, revenues or percentage CAGR growth in top line do you envisage?
So how we look this opportunity is that if the steel consumption has to grow by, say, 10% over the next 10 years as per the government target, and if the structural steel industry is able to reach to the global normalized levels of 10%, yes, the opportunity size could be 4 times on which we are sitting today. And APL having 40% market share and growing, we should be the major beneficiary. And how, another point is that, see, we are creating this market, right? Our volume growth in last 10 years has been above 20%, whereas the industry has not grown at the same pace. So it means that we have created a new market for ourselves, and we have to continue to do this going forward. Only then we can see that the industry could grow to the levels which you just spoke about. So we are what we are trying to do is we are trying to educate the architects, the structural engineers, the developers, the contractors, that if you switch to structural steel tubing for your construction applications, you can save time, you can save money, you can be environmental friendly as well, right? I mean, 4 or 5 months ago, there was a major crisis in New Delhi regarding the air pollution. 8-9 months before that, there was a crisis in Chennai regarding water trouble. In both the cases, the government banned the construction because the RCC, the cement, the concrete, it
Sure.
adds on to the air pollution because it creates dust in the air. and it also requires groundwater for mixing. If you make a building out of steel, which we are seeing outside India, you neither need groundwater, and you don't need, and you will not cause air pollution as well. So as these trends emerge in India,
Sure.
and we educate our channel partners on this, I think what numbers we are saying, we can achieve that, and APL being the largest market player
Would benefit more.
It
Sure.
will definitely benefit us.
Okay, well, wish you all the best for that and more. Thanks so much for speaking to us today, Anubhav, and all the best for the quarters ahead.